Back to all-time highs. It is 30 minutes ago until the start of trading. I'm Dani Burger.
And I'm Michael McKee. Bloomberg Open Interest starts right now.
Coming up on the show, the S&P extends its winning streak even as sky-high AI spending sinks SpaceX. Ken Griffin's Citadel is already cashing in on its bargain bet on situational awareness. And Wall Street banker bonuses are set to climb yet again as volatile markets boost profits. Speaking of those volatile markets, let's look at SpaceX. Now it is down 11.3% in the pre-market. Its first earnings report it had after the bell yesterday. AI spending doubled from the first quarter and is expected to climb faster than Wall Street estimates. CEO Elon Musk did tell analysts that SpaceX will reach a $100 billion annual run rate of revenue by the end of the year. So beats across the board, but there was this big spend meatball just hanging out there for the market to sell shares. Let's discuss with Bloomberg Tech host Ed Ludlow. Ed, just break down what your takeaways were. You were live on Bloomberg TV as these earnings were coming through. Clearly, the market disappointed about some of those spending numbers.
Yeah, I mean, spending in the quarter gone was $18 billion, but 86% of that is just AI infrastructure. And so, like, a lot of people are posing the question, like, what is SpaceX? Like, literally, is it a rocket company? Is it a space company? Is it an AI company? And, you know, the interesting thing is that in aggregate across the spending numbers, but also the $100 billion ARR, it is the business of cloud services that is growing and the biggest contributor to that growth. You know, literally renting compute capacity to third parties. They're contracted $6.7 billion incrementally in this current period. And so, like, for all the future, the progress with Starship, a year from now, Musk says they'll be launching Starship once a day at least. The idea that they'll hit $1 trillion of revenue in 2030, not ARR, real revenue. You know, the here and now is that this is a company that rents compute capacity.
I got to wonder, Ed, there's a little bit of Wizard of Oz to this. So pay no attention to the numbers behind the screen. Look to the future. And I'm wondering how analysts are taking that, given the massive spend that they did and the reaction to that. And then Elon saying, well, yeah, but it's all going to be great down the road.
Yeah, I think that we're still tracking in the interim the progress of the Starship launch system. What Elon Musk said was that the next test of Starship will come within the month. You know, the reaction broadly is that there's a gap, right? You know, Mike McKee, with the greatest respect, I'm old school like you. So I hit FA Go on the Bloomberg terminal, and the street sees SpaceX doing $300 billion of sales in 2030. And last night, Musk said they'll do $1 trillion. And so, like, the reaction of the street is that, you know, at least in the 12 hours overnight, they've not remodeled for the guide that Musk gave on the call.
Who'd thought? Yeah. Fundamentals.
They matter, apparently. What about the guide for Starlink and the success they're having there? It seemed to be a management that was talking about them to really challenge the current mobile providers that exist in the world.
Yeah, this was a big moment in the call, you know, not just because the main US carriers fell sharply in the after-hours session, but the way that Gwynne Shotwell, the president of SpaceX, explained it is that they are building out a satellite-based constellation, Starlink direct-to-cell and the broadband service, but they're going to invest heavily on terrestrial infrastructure as well, and basically offer a better mobile service than the carriers currently offer. And, you know, the thing that moved the needle to the downside for the shares of those carriers was Gwynne Shotwell saying that their expectation is they will acquire customers from T-Mobile, AT&T, and Verizon because what SpaceX plans to offer to their mind is better than what's available currently here on Earth.
All right, Ed, thank you so much for joining us. Looking forward to Bloomberg Tech, 11 a.m. Eastern. Ed will have more coverage on SpaceX earnings as well as the Uber earnings with CEO Dara Khosrowshahi. Elsewhere in the world of earnings, Disney is gaining after the company beat estimates thanks to stronger streaming profits and solid demand at theme parks. Let's get more with Bloomberg Intelligence media analyst Geetha Raghunath. And Geetha, what were your takeaways?
Yeah, as you pointed out, Dani, the two parts that matter most for Disney, which are, the parks and streaming, and both those delivered really strong results. I think coming into this quarter, investors were definitely very, very concerned about the health of the parks, just kind of given the general consumer softness that we've seen, and also some commentary from Universal Parks, from Comcast, suggesting that there was a slowdown in their domestic parks. But what we saw from Disney was exactly the opposite. Their parks profit rose by 20% versus consensus expectations of 10.5%. And really what they pointed to was very, very strong attendance trends, both at the domestic parks, and very strong per capita spending. And so I think that really allays a lot of fears. And then on streaming, we saw them kind of more than, outperform expectations, again, getting to a 13% operating margin. Now, remember, operating margin is really what matters in this business. And everybody's trying to get to that North Star of about 20, 25, 30% where Netflix is. But looks like Disney's making really, really good progress on that front.
Now, they announced a tie-up with TikTok, and I'm wondering if that's offense or defense for them.
I think it's a little bit of both. So, Mike, as you know, Netflix is the first one to really kind of get into this vertical video or the short form video content. And really what this is, the streaming wars are not really just competing with, your streaming, rival streaming services. It's really competing against YouTube, against TikTok.
This idea that everyone's being more distracted by TikTok. So if you can't beat them, why not join them?
Well, that's why I asked if it's a defense, if
Yes.
you got to meet the customer where they are.
Yeah, although, now my TikTok will just be flooded with like Mickey Mouse or whatever it is, which will be fun for us all. Other earnings news that Mike and I are looking at this morning, Eli Lilly and Novo Nordisk in the green. They raised profit forecast. Novo CEO joined Bloomberg this morning speaking on their future plans.
On one hand, Novo Nordisk has a phenomenal pipeline and a lot of R&D knowledge. But we also have concluded that we don't have a monopoly on the best ideas. So we are right now looking at bolt-on acquisitions to try and complement our own assets and see basically how we can serve the world in a better way.
Joining us now is Bloomberg Intelligence senior pharmaceutical analyst Sam Fazeli. And Sam, maybe it's instructive for our purposes to also note that Eli Lilly had earnings, and there they raised expectations. And it feels like a disappointment coming from Novo. Is this just how it goes, that both of them can't succeed, that one needs to be taking market share from the other in the obesity medication race?
Yeah, Dani, I don't know why you're disappointed with Lilly, or maybe I haven't looked at the latest pre-market trading. But, they've raised EPS guidance for the year by 8%. The 2Q beat was solid and real across the board from their products mostly. And the $2.4 billion or 11 or so % beat in 2Q pretty much all flowed down to the net earnings, about $2.1 billion beat there. So, I don't know what this company needs to do to keep people excited and happy.
Well,
of course, they're sitting on a hefty valuation.
Jump in, because I'm worried I might have misspoken. If I meant to say that we were disappointed on Lilly, it seems like we're not. Shares are up in the pre-market. It's more Novo Nordisk. It seems like there's disappointment around.
Yeah. Sorry, Dani. So I'm just looking at the share price chart here. Novo Nordisk, I think the issue they have there is that the numbers, although they didn't particularly beat on a high quality end of the spectrum, whereas Lilly did. And, the CEO has a good, positive view of their pipeline. The market tends to disagree a little bit here. That is happening with several pharma companies right now. Investors and analysts are not exactly seeing the same excitement in pipeline of some companies like Pfizer, like Novo Nordisk, as the company's management are. But they also both have acknowledged, at least Novo Nordisk did, I think Pfizer's done its M&A, that they're going to go and acquire some pipeline. So the issue that Novo has is that it needs to show how it's going to grow, especially that CagriSema, their big white hope, didn't quite get to the points that they had hoped to in terms of performance.
In differentiating these two companies, I was listening to David Ricks this morning, the CEO of Lilly. He spent a lot of time talking about what they're doing on the marketing side as opposed to the drug development side. And I'm wondering if there's a difference between Lilly and Novo Nordisk, especially when it comes to the weight loss drugs and the pricing deals that Lilly's making and the Lilly Direct and that sort of thing.
Yeah, so Novo has very similar methods in play to try and maximize its access to patients, or maximize patient access to its drugs, to Lilly. The thing is that particularly for Lilly, the big excitement in the second half is their oral drug, which is Foundayo. It does have some, it has been not as exciting as the Wegovy launch, the Wegovy pill launch from Novo Nordisk. So everyone's now looking to the second half to see whether their methods, particularly Medicare access and direct-to-consumer advertising, is going to drive that growth. There are some big numbers in analyst models, if you look at the MODL function on Bloomberg, that talk about something going from a 92 million or 98 million this quarter to 17 billion in a few years' time. So there's a lot of wood to chip for Lilly there.
Am I right in that Novo was first to the market with this pill, or was it Eli Lilly? I just wonder if, like, if the first, okay, so is first mover advantage not a thing anymore, Sam? Is that less important in this case?
Well, it has been until now. So Wegovy pill launch has been much more interesting and exciting than the Foundayo pill, but Foundayo has a limited marketing at the minute. As I said, their DTC only just started in direct-to-consumer advertising, only just started in the early July. So that probably will help. And also, don't forget, Wegovy pill is Wegovy. People are familiar with that. Foundayo is a new drug. So if you were Mounjaro pill or Zepbound pill, it might have been easier to tell that story. But Lilly has got it, so as I said, it's got a lot of wood to chop on this particular one.
Hey, Sam, thank you so much for joining us. Always appreciate your insight. Bloomberg Intelligence's Sam Fazeli. Let's get a check on your markets. 20 minutes to play for until your trading day begins. We are adding to the rebound, up 0.5%. S&P outperforms. NASDAQ underperforming, maybe because of SpaceX and AMD earnings dragging things down. Still up 0.25%, though. The U.S. 10-year yield, that moves higher by a basis point as Brent crude climbs 1%. We are awaiting a possible announcement on a deal with Iran and Oman over allowing the Strait of Hormuz to be reopened. We will bring you that if and when it happens. Let's get a look at some of the other movers on our radar this morning. With that is Nora Melinda. Good morning, Nora.
Hey, Dani, a bit of a mixed bag this morning, so let's get right to it. Kicking things off with CVS, giving investors a little bit more confidence this morning after raising its full-year profit outlook after a better-than-expected quarter from its Aetna insurance business. The turnaround story may be finally picking up some steam, but we are seeing shares lower sharply by more than 9%. Maybe some potential weakness next year when it comes to its Caremark membership. Now from healthcare over to rideshare, we're seeing Uber also under pressure, down about 2.7%. The company gave a bookings forecast that basically met expectations. Now, normally that's fine, but on Wall Street, fine isn't always good enough. The company also says that competition in Brazil is heating up, which is adding to questions about how Uber keeps growing as robotaxis become more of a reality. And finally, one thing people don't seem to be cutting back on is travel. We're seeing shares of Booking up about 7%. This is after the company topped expectations on Wall Street. International travel demand is still holding up, even with all of that economic uncertainty. CEO Glenn Fogel joins Open Interest later this hour after the closing bell. Those are your movers. Dani?
Nora, thank you very much, and we're very much so looking forward to that interview. Coming up, Wall Street bankers reaping the rewards of a volatile market. Bonuses are set to climb yet again. That's up next. This is Bloomberg. Let's get you some high-interest stories, a look at what's making headlines around the world. President Trump says a deal to reopen the Strait of Hormuz could come within 48 hours. He says the U.S. and Iran talks are moving along very nicely. Reports say that U.S., Iran, and Oman are negotiating a 60-day shipping agreement, though Tehran says any reopening still depends on changes in U.S. policy. Abdul al-Sayed is projected to win Michigan's Democratic Senate primary, defeating establishment-backed Haley Stevens in a race seen as a test of the party's progressive wing. He will face Republican Mike Rogers in November in a race Democrats must win in order to have a chance of taking back the Senate. Wall Street bankers are in line for the biggest bonuses this year as deal-making and trading stays hot. A new Johnson Associates report forecasts investment banking bonuses rising 10 to 15%. Equity traders and underwriters could see payouts jump 30% or more. AI also helping banks cut jobs, boosting pay for top performers. And we're going to talk to the author of that report in the next hour, Chris Connors. But first, joining us to break down the study is Bloomberg finance reporter Catherine Doherty. Cato, I mean, these guys work hard. They probably deserve that 10 to 15% pay bump, just given how crazy things have been on Wall Street.
Yeah, it's been super active, and we haven't seen it pull back in any way. So, as you pointed out, the traders are projected to see the biggest payouts, some more than 30%. Investment bankers, though, I think that's the story to highlight. This year, we've seen a resurgence of M&A. Deals have come back in a way that we haven't seen, and we've been expecting for a few years now, but now we're actually starting to see the IPO pipeline and some of the other M&A activity come through. So you're expected to see that reflected in end-of-year bonuses. There are a lot of caveats to this report. We still have the remainder of 2026 to get through, so we could see a big pullback and the markets could change. But right now, all things are indicating that the end of this year is looking pretty good across the board.
Got to wonder what oil traders are feeling like in terms of their bonuses this year. I'm wondering the part about AI eliminating jobs, and that it makes sense that the higher paid are going to get more for it. But what about the lower paid levels who are still around? Are you going to get people cheaper because there aren't that many jobs?
I think that there's been a lot of discussion amongst the leaders of the big banks that have talked about the moving around of their employees. So when you're talking about maybe those lower paid or back office workers, you can shift some of those folks that you don't need anymore into jobs that still do need a human interaction and can't be taken just over by technology and AI. So I think that is the shift that we're going to start to see. We haven't yet seen a big change in the numbers at the banks. They have not really been adding headcount, but at a lot of them, their headcount has stayed very steady. So there hasn't been a lot of concern, again, yet, that we have seen about massive layoffs. But at the end of the year, this pay is likely to filter into the top performers, and that often is the banks, traders, and investment bankers that we've been highlighting and talking about.
What about the rest of the financial world? Mike and I later in the next hour are going to be speaking to Carlyle CFO, and I know they're talking about how they've had so many realizations they've been exiting. But the rest of this industry, it feels like it's been at a stalemate. How is that reflected into pay, specifically in private equity and maybe other parts of the private capital world?
So private equity, private credit, that is an industry that hasn't seen as much of a boon as we have highlighted in other parts of the market. So I think that that is probably the more muted part of finance to look at. Asset management, though, still up as much as 11%, so in the double digits. Wealth management, 5 to 10%. So it's really, if you zone in on some of those markets that haven't seen as much of the activity that we have seen in, let's say, trading or M&A, more of the public market activity, yes, I do think that that's something to highlight as a differentiator across the board.
And I think we're going to have to ask Carlyle if his people are getting bonuses, big bonuses. I think it's inevitable now. Catherine, thank you so much for joining us. Bloomberg's Catherine Doherty. And again, we'll have the author of this report on shortly, as well as that Citadel interview, Carlyle interview. We are going to talk about Citadel, though. That's going to be coming up after this break. Their flagship fund soaring in July after buying a discounted portfolio from the hedge fund Situational Awareness. This is Bloomberg Open Interest. Citadel's flagship fund surged nearly 6% in July after the firm bought a discounted portfolio of AI stocks from troubled hedge fund Situational Awareness. Bloomberg's Hema Parmar has been reporting on this and joins us now, who's been publishing hit after hit of such fantastic pieces about the strange moment for hedge funds that we're living in. I mean, your reporting is remarkable. They were basically flat year to date before this deal, and now they're up 12% year to date for their flagship fund.
So they were flat for the month.
For the month, yes. Thank you for that.
But up now, nearly 6% on the month. So it really shows what kind of a return a deal of this size and scope can make for a multi-strat hedge fund. They basically made more in 1 month than they had the whole year. They were up about mid 5% through the year up until this deal. Now up 12%. Pretty impressive.
What about the folks left over at Situational Awareness? That's still around, right?
It's still around. They still have more than $10 billion in assets. A lot of that is in their private stocks, in the private companies. So a big stake in Anthropic, among a few other companies. So they also still have the remaining shares that were not purchased by Citadel. So those two have likely risen in value in the rally that we saw after the deal was announced. So they are still around. They are still sizable.
So Ken Griffin clearly makes a killing from this transaction.
Yes.
What about the rest of the hedge funds of the universe that you've been reporting on, whose returns were troubled because of their AI exposure?
Yeah, so we are seeing the pain really flow through the space. Whale Rock down a significant amount for the year, down 22%. Really painful experience for that fund. This is a fund that's concentrated and makes AI bets, down 22% for the month, I should say. Still up on the year, but it really does show these firms that are highly concentrated and have a really strong point of view. We've seen losses at Co2. They were down 8% for the month, which is their worst month in over a year.
Yeah, I think about this thing Joe Weisenthal pointed out, that with LTCM, people thought they were diversified, but the thing they had in common was LTCM held all of the stocks, so maybe a repeat past his prologue. Hema, thank you so much for joining us. Great to have you, and excellent reporting again. Bloomberg's Hema Parmar. Let's get a check on your markets. Just 5 minutes to go until your opening bell. The rebound continues after notching an all-time high for the first time in 2 months. Tech lags, though, thanks to disappointing earnings from SpaceX and AMD. To be clear, both those companies beat expectations, but the expectation was somewhere else, especially when it came to spending. Your 10-year yield, that's at 462.48. That's higher by about a basis point this morning as Brent crude climbs back above $80 a barrel, but we were closer to 90 to start the week and last week, so this is at least some relief. Less than 4 minutes until your opening bell. We're going to begin the U.S. trading day with JP Morgan's Mira Pandit. You're watching Bloomberg Open Interest. Just seconds away to the start of your trading day. This is Bloomberg Open Interest. I'm Dani Burger alongside Matt McKee. Matt Miller is still off. S&P futures looking at another record close after the first yesterday in 2 months. Outperformance, though, the overall market is tech only up about 1/3% after both SpaceX and AMD earnings. We have AB InBev ringing the opening bell down at the New York Stock Exchange. They're, of course, cross-listed on the NYSE. They are a Dutch company, I believe. They're up year to date. I guess beer is recession-proof, or not that we're in a recession, but any consumer weakness, people will still buy their beer. Atovia ringing the opening bell at the NASDAQ. They are a Goldman-backed company, biotech company, and they are IPOing. You're the IPO, as John Gray says. Some of the stocks that we're watching, SpaceX, that's down 11% in the early moments of the opening market. It reported its first earnings report since they IPO'd. AI spending doubled from the first quarter. That was the problem. And it's also expected to climb faster than what Wall Street thinks it will. CEO Elon Musk also told analysts that SpaceX will reach $100 billion in annual run rate revenue by the end of the year. That's not enough for them, now down 12%. It's this concern about AI spending and an increasing universe of investments that is centered around that. Earlier, I asked Brookfield Asset Management CEO Connor Teskey, off the back of their earnings, how he is looking at AI volatility.
The demand we are seeing so far exceeds the pace that these projects can actually get pulled out of the ground, that even if demand was to slow or plateau, that supply-demand imbalance would be there. Dani, perhaps the way I would say it is, when we look at the AI infrastructure opportunity, because the demand and the opportunity set is so large, we feel we can be incredibly selective.
Joining us now is JP Morgan Global Market Strategist Mira Pandit. Mira, great to see you this morning. And look, I think a lot of people are looking at the numbers these hyperscalers are putting up, whether it is SpaceX or Alphabet or otherwise, and saying the spending is going to continue. I'm putting aside any nerves. I'm going to take opportunities and buy. Do you think you can do that in public markets too? Given this sell-off, are things more cheaply on a trend that seems to have some staying power?
The hyperscalers at this point are essentially at the same valuations as the S&P 500 overall. And we're seeing this AI rotation strike again, where the former losers in the first half of the year, like the Mag 7, the hyperscalers, software, are having great gains so far this quarter. So you have the Mag 7 and the hyperscalers up about 8-9% year to date. You have software just in this quarter so far up about 20%, whereas semis are down 10%. So you do see this sentiment shift going on, and it makes it very tricky underneath the surface for asset allocators, because you look at something like value, for example, versus growth, outperforming by about 7.5%. 54% of the return to value just this quarter is coming from the three stocks that increased in weight, those big Mag 7 companies, in that Russell rebalance recently. And that's taken away from growth, and so it's reinforced. I mean, boy, value got a good deal from rotating from some of the winners to now the new winners here, whereas growth is lagging behind basically 40% of that from just the one semi stock that they inherited. So all of this rotation underneath the surface has really reinforced to us you want to be diversified within the AI trade. It's not semis or hyperscalers, Mag 7 software. It's a mix of all of them, because the sentiment is driving flows in one direction or the other while the fundamentals are still there.
Well, you're talking about hyperscalers, one word to refer to a lot of people, and you're talking about sectors here and being diversified. At this point, does it matter which companies are investors differentiating at this point, or do you just want to get a hyperscaler because you know they're all going to go up?
It absolutely does mean we have to think about company selection in particular, because again, even to your point, within those hyperscalers, what's driving that value return so far this quarter is the ones that came up big last week when it comes to earnings. So it's really the three stocks that were out of favor for the first half of the year are in favor. So increasingly, the AI trade is creating definitive winners and losers, as opposed to anything with some AI tag to its name is doing well. Now there's so much more differentiation, and it's harder to find diversification by just looking across different sectors or styles, because really at the company level, they are differentiating themselves.
There has been some real volatility, not just in the equity market, but in debt markets too, especially given just how much they are issuing. We saw CDS spreads for a lot of these big tech companies climb up quite dramatically. They have backed off as the market overall is rallying, but some people have looked at this and said the cost of capital is going to start to get more expensive, and there will be real market pushback just at the amount of borrowing these companies are doing. In your mind, does that raise red flags for the sector as a whole if borrowing is starting to get more expensive or their debt starts to trade below par more dramatically?
Just as the trade is rotating, so are the risks. So it's no longer we need to be spending more and more and more on the Capex. It's how much revenue upside surprise is beating the Capex upside surprise. You still want Capex to signal that there's demand, but that ROI needs to come through in a bigger way, especially because it's not just these companies financing based on cash anymore. It's going out to the markets in the debt side, on the equity side. So certainly that ups the ante in terms of what results need to be. And you see it that in the early days of this trade, you did well and you got rewarded handsomely. Now it's less so. I mean, semis, you look at semis making up about 60% of earnings growth in the S&P 500, upside surprise of about 20% on average, but down about 8% since the first semi reported. So markets are being very discerning in this regard.
What's happening in the rest of the market besides AI and tech?
Because there's anything else?
We tend not to talk about it, but there are 500 companies in the S&P 500.
Absolutely. It's just become so concentrated. I mentioned the earnings growth being concentrated around semiconductors, the markets itself, whether it's value or growth, around the same cohort of companies. Even with areas like small cap, you're seeing that AI was a big driver in the second quarter itself. Now, again, given some of the rebalances to the indices, that AI load has been lightened up a little bit. But I think that the challenge is you look at areas like small cap that have done well so far this year. It's a mix of catch-up trade, bit of a low-quality rally in the first half, and then that AI piece, a lot of that which is blending with the low quality. And ultimately, when it comes back to earnings, maybe some of these S&P 500 companies are not being rewarded as much for earnings, but the results are still stellar when you look at the year starting at 15% earnings growth expectations coming up to 30. You look at small cap, you've actually seen a 20-point downward revision. So the reason there's so much focus is because not only the concentration, but the results that we see. Now, there's glimmers of other things going on. You see just this quarter so far, financials is one of the stronger performing sectors. But again, that has almost a picks and shovels aspect to it when you point out the enormous financing needs that are coming to the market.
Why are international stocks still outperforming? I think that gap has started to shrink when big tech has come up, but something like 3 percentage points. FTSE Russell ex-US world index is outperforming. Why, when it seems like so much of the AI world is concentrated in the US, maybe save for Korea and Taiwan? What's giving international stocks their lasting power right now?
It is the Korea-Taiwan story in a major way. It's not the China-India story of the past when you think about emerging markets. It's really about those supply chain bottlenecks around AI and who some of these beneficiaries are, and the enormous earnings growth that's coming from that. Korea and Taiwan are one piece of that. Even when you think about Japan, about 60% of their earnings growth is coming from AI-related companies. So AI has certainly gone global, and it has its tentacles in other places. I would say that some parts of Japan, some parts of Europe are still leaning into the defense, the industrials, the banks, where you get a little bit more diversified exposure there. But it is thematically very difficult to find genuine diversification in the markets, which gets back to the point about single stock selection and where you can pick out some of the stories that have other elements folded in.
Hey, Mira, thank you so much for joining this morning. Really fantastic to see you. That's JP Morgan Global Market Strategist Mira Pandit. Nearly 10 minutes into your trading day, let's see how markets are faring. And we are on track for another record high, up 0.6%, trading at 77.84 this morning. Breath is pretty even between gainers and losers. You have some earnings that seems to be fueling us. Eli Lilly, the second best performer in terms of points added, seeing its biggest one-day rally. At one point, it was up 9%. That would have been its biggest intraday rally since April 30th. Broadcom, Alphabet, Meta. So it's a who's who of some of the hyperscalers. Nvidia adding the most points at 24 points added. On the downside, I know this is a little bit hard to read. This one right here that says Avan, that's advanced. AMD, that's up there in terms of losers, down 5%. With an earnings that beat, just let that sink in. AMD beat earnings and they are down 5%. It's a pattern that we see that the expectation is much higher for these companies. Tesla is down following the results of SpaceX, down 1%. Maybe it means that there's less likely of a deal. I don't know if SpaceX didn't perform as well. CVS also reporting earnings. That's down in the loser category too. Uber also reporting earnings, down in the loser category. So if we look at how these sectors are shaping up this morning, some push and pull between how different tech is performing. But healthcare, that's at the top. That's going to be thanks to Eli Lilly and those earnings. Materials, consumer communications up there, and infotech, utilities, energy, real estate round out the bottom of the performance. Coming up, another earnings story for you. Strong travel demand drives results at Booking Holdings. We're going to speak to the company's CEO, Glenn Fogel. That's up next. This is Bloomberg. Time now for your top calls. Here is Nora Malindo with some of the analyst action that she's looking at this morning. Good morning, Nora.
Hey, Dani, 3 on the docket for you this morning. First up, Jefferies saying that they're getting cautious on Best Buy and downgrading the stock to hold. Jefferies is saying that higher laptop prices tied to memory chip shortage could make it harder for the company to keep growing earnings. And with back-to-school shopping already underway, it'll be interesting to see whether or not shoppers are actually willing to pay up. You're seeing shares of Best Buy down just below 3% right now as we speak. Now over to the beauty industry. Bernstein says don't sleep on e.l.f. Beauty. The firm upgraded the stock to outperform and says its new hair care business could be a meaningful driver for growth over the next few years. It also says that e.l.f. has cracked the code on social media, not only rolling out products quickly, but turning them into viral hits. You're seeing shares of e.l.f. to the upside, higher by about 0.4%. And finally, Wall Street is giving Booking another thumbs up after its earnings report. Despite everything that's been happening around the world, people are still finding a way to travel. And CFRA says the company's outlook may be a little bit too conservative, which could leave room for a positive surprise if conditions in the Middle East improve. Those are your top calls. Dani?
Nora, thank you so much. And a perfect setup because now we are joined by the Booking Holdings CEO, Glenn Fogel. Glenn, we got to start there. I mean, this is a world awash in disruptions. There's the hot weather across Europe. There's Middle East angst, which is also leading to higher fuel prices. Why is there still so much resiliency and demand for travel?
No, and you pointed out exactly what is happening. And thank you so much for having me. The issues that we face time and time again are, one would imagine you're not going to see travel, yet it is a very resilient industry. People want to travel. And if they can't do what they want to do at first, they'll come up with another thing to do. So, for example, a lot of the lift that would be between Europe and Asia goes through the Middle East. Well, a lot of airlines had to pull back that lift. People can't afford the more expensive nonstops that were still available. So instead of going, say, from Paris to Bangkok, maybe they went Paris to the south of France. Now, of course, you do have the hot weather. Of course, that's been an issue. So maybe instead they decide to go to Norway. But the fact is, people want to travel. They're going to continue to travel. And yes, these type of instances do end up hitting our bottom line. There's no doubt we would do better if there wasn't a war in the Middle East. But I'm still very pleased with how we performed for the quarter.
Now, there is always a difference between the front of the plane and the back of the plane. But in overall travel, you own a number of different platforms. Are you seeing any kind of economic differences between people in terms of what they're choosing and where they're going?
Well, we announced last night how we were very pleased that we continue to do well in the U.S. And the U.S. is an area where we're smaller than other parts of the world. A lot of people don't know that, how global we really are. We're numbers about a low double-digit percentage of our customers are in the U.S. So that's rather small compared to the total amount of business that we do. But we did very well, high single-digit growth. That's good. Now, other parts of the world, obviously, a lot less well. I mean, obviously, the Middle East, that was hurt a great deal by the start of the war, but it did start to normalize in June, people in the Middle East who are traveling. However, people are still a little bit concerned about traveling to the Middle East, so that's still a little bit of a damper on that business. But the good thing about us is we are so global, where one area is having a problem, another area can do well.
I guess just to further emphasize Mike's question, Glenn, is the behavior changing more than just rerouting where their travel is to get around these headwinds? For example, are you seeing people book shorter stays? Are they maybe opting for the 2-star hotel instead of the 3-star hotel or the alternative booking? Is there anything in the behavior that essentially suggests a shift that might reflect some economic concerns?
Well, look, we did see a decrease in the length of stay. That's an indication. But again, the way I look at it is I try not to go into those type of metrics that you mentioned because they can be very specific to a different region. So you look at the US, say, versus Europe or Asia versus our rest of the world, we call it. Those things will have different metrics, et cetera. From my point of view and for our investors, it's always look at the global, look at our bottom line, look at the overall growth rates. Don't try and figure out a slight metric in one area, what that's going to indicate for the long-term future. The long-term future is travel is going to continue to increase better than GDP. Our job, get an increase in the share of this growing industry.
You also have OpenTable as one of your businesses, and we used to look at that all the time during the pandemic to find out how people were doing with their spending. You go on vacation maybe once or twice a year at most, but a lot of people go out to dinner all the time. And so I'm wondering how that area is holding up as people get more concerned, as we see the consumer confidence fall. How much of an indicator is that of where the economy is?
Yeah, no, it is a nice indicator. I'm very proud of the team over at OpenTable. They've been doing just fantastic over the last couple of years, adding more restaurants and being able to provide more services both to our with two kinds of customers, both the person who's the diner, but also for the partner who's the restaurant owner, providing more services both sides. It's been great. Now, your question is, can we use that as some sort of proxy for how the consumer is doing or not? I'm not sure you really can or not. I know we're doing very well in that area, but again, two things to think about is majority of people do not eat out most of the time in the U.S. And again, we're just talking most of the U.S. OpenTable is international, but the overwhelming part of the business is the U.S. And as I point out, we are extremely global.
Glenn, just to wrap things up, I know you and the team on your call yesterday were talking about the idea that AI-driven traffic is still well under 1% of your room nights. When do you expect that to change? Do you expect at some point that AI will make up a meaningful proportion of it?
Well, there are a couple of ways to think about that. The first thing is, the most important thing in my mind is making sure we are continuing to develop our own services using AI. So people, when they start thinking about travel, they come to us so they can do their discovery, do all the things they want to explore, where they want to go, what they want to do, and then from there transfer into actually doing the bookings. That's part of our connected trip. So they do it all in one place, holistically, seamlessly, frictionlessly. And then, God forbid anything goes wrong, it's one point of contact that we can solve it all. And as you know, when something goes wrong in travel, it's like dominoes, one thing after another. So we can solve all the problems at once. And we're using Gen AI to make it so much better to do that. That's game number one. Now, game number two is people are going to continue to start in other places they've always had in the past. Before there was digital commerce, people were looking at magazines, brochures, or guidebooks. Then they start going online. They start looking at other ways. And of course, most recently before Gen AI, Google was a nice way people would start their discovery. Now, the question people bring up to us is, well, are people going to use Gen AI, whether it be Gemini or ChatGPT, pick your favorite model. They're going to start there. And then are you, Booking, going to have to pay for the people to come to you to do the booking or not? That's the question. Now, look, we've paid in the past a lot, always. Google, and we're great partners with them. We paid a lot of money to them to be able to put our advertisements in Google. We've gotten a nice return on that. But a lot of people don't realize, approximately 2/3 of our customers are coming to us direct. A mid 60% of our B2C business to consumer business comes to us direct. They're not going to Google first. Now, the fact that right now it's less than 1% coming from these LLMs, will it grow? Probably. When? I don't know. And will we have to pay? Probably. We're doing advertisements right now with ChatGPT. I do believe, though, in the long run, it's good for us. We get to diversify new channels of demand. This is all good for us.
Glenn, we're going to have to end it there. Thank you so much for joining off the back of your earnings report. Glenn Fogel of Booking Holdings with shares up 5% this morning. Coming up, the AI trade roars back this month. The NASDAQ 100 gains more than $3 trillion in value in just 4 days. We'll catch up with Mandeep Singh. That's coming up next. On some of the big movers this morning, Nvidia is up higher. Micron is as well, but AMD and SpaceX fall after they report earnings. Let's dig into the AI trade with Bloomberg Intelligence head of global tech research, Mandeep Singh. AMD and SpaceX falling for different reasons, but the theme is the same. Report earnings, beat on most of the metrics, but investors still find something to be disappointed in.
I mean, in the case of SpaceX, it was really a big outlook. They threw away a $100 billion ARR number. When you think about, what's behind that, huge Capex ramp. They're talking about 10 gigawatt capacity by next year. You know what that would entail? Probably in excess of $200 billion in Capex. So right now, we are just in that mode where everyone is topping each other in terms of their Capex plans.
Nvidia just going to be like, hey, here's some money to buy our chips to fund that, billions of dollars that you're going to need for all those gigawatts?
That probably is the case, given SpaceX is a company that doesn't have the operating cash flow like the other hyperscalers who are making those $200 billion Capex investments. So from that perspective, given SpaceX said they are going to rely on Nvidia for all their chips, I'm guessing there will be some backstop from Nvidia because obviously they'll have to raise a ton of debt. In this case, we're talking about $200 billion plus in Capex when a company doesn't even generate $5 billion in operating cash flow. So there will be a lot of debt financing. I hope they don't end up doing equity raise here, but clearly, they've laid out big plans, big numbers. The market obviously doesn't believe it. Which is why you see that stock reaction.
Yeah, erasing well over $100 billion in market cap this morning. Mandeep, thank you very much. Coming up in the next hour, Mike and I will speak with Sarah Ketterer from Causeway Capital on bargains in healthcare and consumer stocks, plus Chris Connors from Johnson Associates on Wall Street bonuses. Then we'll hear from the CEO of Brookfield Asset Management and the CFO of Carlyle after the two's earnings. This is Open Interest. 30 minutes into your trading day. Welcome to Bloomberg Open Interest. I'm Dani Burger alongside Michael McKee, and we hit another record high today. Yesterday, we hit the first one in 2 months. It's not as big of a gain as it was yesterday. We're up about 0.6 for both the Nasdaq and the S&P this morning. Maybe we'd be up higher if it weren't for SpaceX and AMD earnings. In both cases, we saw both of those companies report earnings that exceeded expectations, but still, it wasn't good enough for this market. We also, Mike, have some economic news crossing the terminal. Now you're looking at ISM Services.
Well, this is kind of what passes for good news. ISM Services Index rises to 54.1 from 54. So not a huge change. Service industries are apparently hanging in there. 54.5 was the forecast, so it's not as good as anticipated. Prices paid, that's the bad news, up to 70.3 from 67.7. And the new orders index is a little higher, 57.2 from 55.1. But employment, 47.4 from 51.2. So employment is weaker, and we saw a rise in employment for the manufacturing PMI on Monday. So manufacturing went up more, and the employment index went up more, and the prices index fell a little bit in manufacturing. So the manufacturing and service industries have sort of flipped in terms of who's got the momentum.
Did we see that reflected in ADP too? Because I was struck this morning, leisure hospitality sector shed 11,000 jobs in July. I wonder if there's something going on there, and maybe if it's World Cup related, over hiring, you let people go
It
sort of thing?
probably is, because you had a huge hiring earlier in the summer, even earlier than economists anticipated. And when you look at the rest of what ADP was telling us, manufacturing added only 2,000 jobs, 1,000 in construction. So not a lot of jobs in manufacturing or services, other than healthcare, which is always the big gainer.
Right, Mike. Just the other piece of data we also got this morning, I know you spoke about it on surveillance, was the quarterly refunding announcement. It seemed like no surprises in there, just continuing to issue on the front end of the curve in T-bills, T-bill and chill.
And that's what's keeping people on edge, because they repeated again what they have been saying for many quarters now, is that we think the auction sizes are adequate. But we all know the debt is going up and up and up, and they're probably going to have to increase auction sizes at some point. And then what tenor do you start selling more of? And they're not telling us at this point. No forward guidance beyond it isn't changing yet.
Right. All right, let's bring all of this to Sarah Ketterer. She's the Causeway Capital Management CEO and Fundamental Portfolio Manager. And Sarah, I know you are looking in areas of this market beyond the pure play AI. And I gotta wonder how you're feeling about the consumer at this moment. Mike talked about some of the ISM services number. The jobs picture looks particularly weak. Their earnings, some earnings are really strong, like bookings, but then Marriott doesn't perform well. There doesn't seem to be any cohesion in the narrative. How are you treating this sector?
Well, thanks, Dani. The Causeway team recognizes the K economy in the U.S. and some of the softness abroad, particularly in Europe. From a consumer staples perspective, that leads us to be a little cautious. From a consumer discretionary area, a sector that's really lagged year to date but has so much potential beneath it, there are great opportunities in the top of the K. For example, in luxury goods stocks in Europe, the likes of LVMH and Kering, where their valuations are near historic lows. They're undergoing considerable operational restructuring. And one of the reasons why we're so bullish on the upper end consumer is because of what you just discussed. The markets are on fire. And this type of wealth effect leads to spending, particularly at the higher end.
Well, when you're spending, you've got to pay the price that people are asking. And unfortunately, these ISM reports are suggesting that we're still seeing inflationary pressures. And obviously, inflation is the link to the Fed, and everybody's concerned about what interest rates are going to be. What are you hearing from various companies in terms of pricing power and whether they're able to push back?
Well, Mike, if they can, they do. But much of this inflation pressure is coming from some basic areas, for example, food and fuel. And those are going to be tough to rein in. So this is the cautionary note. It's what you mentioned earlier about fiscal excesses, and this is happening just about everywhere in the world. Long-term bond yields, as they continue to creep up, and if central banks, including the Fed, can't find a way to get market confidence in reining in this seemingly inexorable inflation, we are going to have some pressure on markets. It seems inevitable that multiple compression will occur if long-term bond yields continue to march higher.
Sarah, you almost sound like something that State Street's Noel Dixon said this morning on Surveillance, and I wonder if you would agree with it. He made the argument that if this Fed doesn't hike, we will see a sell-off in risk markets because of largely what you're talking about. There's a credibility issue to play that the Fed needs to show they're getting inflation under control, and you can't have long-end rates continuing to drift higher, so you need to do something to bring in those inflation expectations. Would you agree with that sentiment that, ironically, markets could actually sell off if we don't get hikes from this Fed?
Yes, it's definitely a possibility to the degree there's, again, in the bond market, lack of confidence and inflation looks as if it's unchecked. Yes, we should see yields rise even further. And so the Fed, as well as other central banks, are attempting this Goldilocks scenario. But there's so many interesting stocks to own, even if there's market softness, because as we know, the U.S. market and some of the emerging markets, especially Asian, are very concentrated in AI-related stocks. But there are other segments that are defensive, and this might be a very good time to think about defensiveness in one's portfolio. For example, healthcare, and thinking specifically of pharmaceuticals, where there's yield, balance sheets are good, and they're massive and underappreciated beneficiaries of AI in their own business.
Well, I'm wondering about healthcare. We were talking earlier about that and the fact that some people think you need to diversify what companies you're looking at, even within a particular sector. It's not that we saw this with Lilly and Novo today. It's not just that everybody is rising on the same tide.
That's very true. Stock selection is incredibly important. But what we'd like to see at Causeway is that we're not paying much for pipeline, if anything. So that's all upside. And also, what I don't think investors are recognizing is that AI creates a kind of lab-in-the-loop model where scientists just become much more productive. New potential molecules are discovered. Development time, drug development time is compressed. Those phase 3 trials are the most expensive part of the development process. This is all around the corner. And then being able to optimize operations for the entire value chain. This, all investors see is loss of exclusivity looming and companies potentially merging to thwart that. But what they can do with AI is going to be transformative and not in the valuations.
Why hasn't this market caught on to that, Sarah? Do you think it is just distraction, that a lot of the capital, a lot of the issuance is just flowing to AI, so these have become neglected parts of this market?
Oh, yes. And Dani, I think there might be several neglected parts, given how concentrated markets are. But we've talked, I mean, you see this bandied about the press, this concept of precision medicine. But AI is what enables that. And this is quite a significant breakthrough. I think some of the important AI leaders talk about how healthcare will be a major area of benefit, but curiously, the stocks don't seem to reflect that. And from a value perspective, that's interesting.
Hey, Sarah, so interesting. Thank you so much for joining us. Sarah Ketter of Causeway Capital Management. Let's get a check on your markets now. Over an hour into your trading day, we are up by 0.6% at another all-time record. NASDAQ just below 30,000, 29,882. Your 10-year yield, that's now a little changed after we saw some of the data come through. We're at 461.07. And also helping yields be better behaved is Brent crude now trading under $80 a barrel at 78.56. Let's look at some of the individual movers. With that is Nora Melinda. Hey, Nora.
Hey, 3 stocks on the move this morning. SpaceX down 8%. And honestly, it's the same story we've been talking about for what feels like forever, AI spend. The company spent more than $28 billion in the first half of the year. And that's what overshadowed an earnings report that actually did beat Wall Street estimates. Now, sticking with tech, I'm looking at AMD, shares lower by about 5%. Now, this is after its sales outlook came up short. And the stock's already doubled this year, so we've really been seeing it on a tear. Investors were clearly hoping for an even bigger forecast, and they didn't get it. And finally, when's the last time you went to a theme park? Disney topped earnings estimates, helped by stronger profits from streaming, and yet another solid quarter for its theme parks. Turns out people are still making those trips, and we're seeing shares of Disney to the upside by about 2%. Those are your morning movers. Dani?
Nora, thank you very much. Very consistently, those parks have been a strong driver for Disney. Coming up, we're going to speak with Chris Connors of Johnson Associates about what's driving another year of big Wall Street bonuses. This is Bloomberg Open Interest. Now to high interest, a look at what's making headlines around the world. President Trump says a deal to reopen the Strait of Hormuz could come within 48 hours. He says U.S. and Iran talks are, quote, moving along very nicely. Reports say the U.S., Iran, and Oman are negotiating a 60-day shipping agreement, though Tehran says any reopening still depends on changes in U.S. policy. A leftover section of a SpaceX Falcon 9 rocket slammed into the moon after drifting through space for 18 months. NASA says the impact poses no risk and is using the event to improve space tracking systems. It still concerns me. The crash comes as SpaceX investors brace for another wave of shares hitting the market tomorrow after the company's IPO. From Main Street anxiety to Wall Street prosperity. Banks are in line for bigger bonuses this year as deal making and trading stays hot. A new Johnson Association's report forecasts investment banking bonuses rising 10 to 15%, while equity traders and underwriters could see payouts jump 30% or more. AI also helping banks cut jobs, boosting pay for top performers. Let's bring in Johnson Associates Managing Director Chris Connors, the author of this story. Chris, I mean, another banner quarter from them, and it makes sense just given some of the results that we saw on Wall Street.
It is, and Wall Street's probably having its best year since 2021, but if you just read the headlines, you might not think that. So we've got geopolitical tensions, private credit stress, record low distributions in private equity, AI's coming for everyone's jobs, but the bonus numbers tell a different story.
Well, I know everybody out there is going to be mad at me for asking this question this way, but it's not necessarily about the brilliance of the people at the trading desks. It's the fact that stocks are going up and stocks are going down. All assets are going up and down, up and down. The volatility has been great, and that's where they're making their money.
Absolutely, volatility is great for trading. And if you look to hedge funds, prop trading firms, the trading desks at banks, we're talking record numbers. Revenues are up 50, 60% at the banks. Some of the prop trading firms are doubling revenue every year or two. So it's really just, they're firing on all cylinders at the banks.
Well, the logical question that seems to follow that is just, is this sustainable? The big IPO of SpaceX has already come and gone. We are going to get OpenAI, maybe we won't. Anthropic we're likely to get. Does it feel like a peak, or does it feel like we can stay at this sustained level of both activity and thus payouts for at least the rest of the year?
The backlogs are incredibly strong, and if you look to the major banks, they're very optimistic about the second half of the year. We're projecting incentives to be up 10, 20, even 30% in some segments of the bank. So the backlogs are strong. As you mentioned, we could have two of the biggest IPOs ever in the back half of the year. Even if they go into 2027, we're talking about positive momentum going forward. So as far as the banks are concerned, this could be one of the best years, of all time.
You're talking about equity traders being up about 30%. Who's the laggard in the asset classes?
Private credit, which, no surprise, it was the darling of the alternative investment industry for the past 5 years. Obviously, you have redemption pressures, there's fundraising pressures, returns are down. Some of the big multi-strat firms will be fine, but if you look to some of the single strat firms who operate in private credit, they're really struggling. Pay's actually probably going to be down. So that's really the only laggard this year. If you look to all the sectors outside of private credit, pay's going to be up.
Well, again, you saw hedge funds, some of them just posting their strongest quarterly inflows in 2 decades. There's been a variety of performance given the AI sell-off that we've seen, the situational awareness of all of that. How does that translate into payouts when, again, they've been doing well year to date, but the ride has been pretty bumpy?
Hedge funds is always, there's a wide variance in returns, but the flows story is a positive one, and many of them have been able to ride the market highs and benefit from volatility. There are certainly talent wars happening in the hedge fund space. You see star PMs getting pro athlete pay packages, usually multi-year deals, guarantees. So we're seeing a lot of talent mobility in the hedge fund sector, certainly in the front office side of the house.
So we're seeing a little bit more, as you mentioned, pro athletes, seeing a little bit more of the free agency going on right now?
We are, and again, if you have a track record either as an investment professional or a fundraiser, there's always going to be a market for your talent. So absolutely.
Another fascinating part of this report, which Mike called out earlier too, is how AI is impacting things. So maybe you have shedding of more jobs because of AI, but that means everybody who's left is getting paid more, which is is great for them. Do you see that fear occurring that you get kind of a hollowing out on the associates level, on the more junior level, and jobs are being concentrated more at the top?
Absolutely, and I think our clients are thinking through career progression. As you have smaller analyst classes going forward, you have to think about what's our training model going to be. If the ratio between junior and senior staff is changing, and you're expecting junior staff to come in with AI fluency, how are we really training them to become the next generation of leaders at our firm? That paradigm is shifting in real time. So our clients are really focused on career progression. Do we have the right headcount? And how do we train our junior staff to be the next leaders of the firm?
We were talking earlier, what about back office people at all these financials, especially now the people who are bringing in and installing the AI?
Great question, and Dani kind of hit the nail on the head, which is those who are left will be better paid. And the idea is, of course, many banks in particular have been able to drive efficiencies with AI, reduce headcount in some back office functions, but those who remain, it's a bigger pie for fewer heads, and the idea is they'll make more going forward as well. So really rising tides are lifting all boats in the investment banking sector.
We have seen throughout history, though, this phenomenon where a new technology comes and sometimes companies overdo it. They basically let go of too many people. They think they can replace too many. I wonder what you're seeing in sort of the evenness and the pace at which banks are adopting this, because I know AI is developing really rapidly. Is it a rapid adoption from the banks too, and thus a rapid letting go of people that they don't need, or are they sort of more slow in terms of having employees be replaced by this technology?
Every bank's got its own story and relationship to it. I think if you look to, this is interesting. A decade ago, Wells Fargo had a higher market cap than JP Morgan. Today, JP Morgan's market cap is higher than Wells, Bank of America, and Citi combined. Over that 10-year period, JP Morgan increased headcount by 30%. So there's not a one-to-one relationship between trimming heads and growth. You can still invest in the right areas, geographies, business segments. Headcount growth, we might see it going forward. Every bank's got its own story, but I think that's a perfect illustration of investing in talent and still finding top-line growth.
Well, you make a good point when you say JP Morgan. My thought immediately goes to Jamie Dimon over that decade. What's happening in the C-suite? Are we going to see even bigger and bigger and bigger payouts to the people at the very top?
We absolutely are. Generally, we say that the generals shouldn't eat before the troops, but the troops are going to be up this year, and the generals will be up even more. And I think as you look to the C-suite of the investment banks, certainly last year, $40 million a year was kind of the floor. That number is going to be even higher at year-end 2026. So, a little bit is competition against other banks, and a little bit is competition against some of the big alts where they also source talent. So we are going to see C-suite executives up at least probably 15% on incentives this year.
How do they communicate this? Because we have seen issues. I mean, I hate to keep picking on Standard Chartered with the CEO over there basically saying, like, we're replacing low-value human capital. He backs off. That's not what I meant. But how do they communicate this? Because it's something that gets booed at commencement addresses. The general population hates it. How do you convince someone to come work for a bank when they are saying, we don't actually need junior workers right now, and we are more reliant on AI in a way that many people, they might find distasteful?
You have to finesse it, certainly, but I think job security is really important. Involuntary turnover is down. So to put it bluntly, I think many people are happy to have a seat at a strong performing firm. And if you can bring something to the table, whether it's AI related or not, you certainly need to show that you're going to be productive, that you're going to add value. And I think there's a future for you if you can find your niche within a firm, regardless of what function you sit in.
Hey, Chris, thank you so much for joining us. A really fascinating report. Chris Connors of Johnson Associates. Still ahead, Brookfield Asset Management CEO Connor Teskey expects this to be a record year for his firm. We're going to bring you my interview. That's coming up shortly. This is Bloomberg Open Interest. You're watching Open Interest, a check on your equity market. Nearly an hour into your trading day, the S&P up about 0.5%. The Nasdaq still up 1/3%, but underperforming. It is at an all-time high for your S&P 500 trade. It is somewhat aided by Brent coming down, but 10-year yields doing a whole lot of nothing this morning. We are just trading flat at 461.88. Let's get through some of these earnings that we've seen. So starting with AMD, they beat expectations after the close yesterday, but it was only a slight beat, and perhaps this market just really wants to see a lot more, just given how high expectations are for anything in the AI trade. SpaceX, that's also down 8%, shedding nearly $200 million off of its market cap after an earnings, which beat on the surface level, but are also spending a lot more Capex. And that's something this market is nervy about if you don't have a return. Disney, solid earnings, good streaming, good parks business. There, Uber, that is down 5.5%. It's under pressure. It had a bookings forecast that more or less just met expectations. CVS, also an issue for them in earnings, down 6.3%. Eli Lilly up 4%. They had strong earnings on their behalf. Their weight loss pill seems to have a lot of traction, more so than Novo Nordisk, despite the fact Novo Nordisk was first to the market with their medication. Coming up, more earnings for you. Brookfield Asset Management raises a record $77 billion in the second quarter. We're going to bring you an interview with the CEO, Connor Teskey, on the other side of this break. Brookfield Asset Management raised a record $77 billion in the second quarter, bringing the year-to-date total to $98 billion. The firm notched its highest yearly fundraising haul back in 2024 at $137 billion. Can they beat it? I spoke with Brookfield Asset Management CEO Connor Teskey and asked him just that. Is he confident that they can beat that figure this year?
Extremely confident. I think the line we used last quarter is we expect this year to be a record year and not by a little bit. Q2, the results, whether it's almost $100 billion raised year to date, record earnings, our earnings, fee-related earnings were up 20%, our fee-bearing capital was up 19%. All of this just highlighting the momentum we continue to see in the business. We like to build and own the critical assets that make up the backbone of the global economy. It's perhaps the greatest build environment in history, and the capital needs and demands for the real assets we focus on, they're at levels today that we've never seen before, and we don't see that momentum slowing down.
Where exactly is the demand and how bifurcated is it? I just see within here some of the fundraising seems to come from the insurance unit's acquisition of Just Group. You talk about the infrastructure build out that you're pursuing. Is it even across the board, the demand that you're seeing, the cash that you're bringing in, or is it maybe more skewed to the sort of infrastructure AI type plays that you're pursuing?
So let's take that in two parts. Where is the capital coming from? We're very fortunate that we've built a business that can raise capital from all the largest pools of money around the world and turn around and deploy that capital into the biggest investment themes. Where is the majority of the capital coming from today? It's still from institutional investors, but we are seeing very large and growing amounts of capital from insurance, from private wealth as well. But then where are we putting that money to work? Without a doubt, the biggest theme around the world that we are seeing today is the investment in energy and infrastructure. And while a lot of that is going into digital infrastructure, we are really seeing diversified demand across the entire industry.
Okay, that's interesting because I wonder, and a lot of your peers are sort of pursuing the same project of this AI infrastructure build out, whether it be the data centers or energy. How do you evaluate concentration risk? Is there a threshold where too many separate strategies start to ride one theme, and that being the AI ecosystem?
Maybe taking a step back, it's important to recognize that, we were investing in clean energy and renewables 30 years ago before people called it renewables. We've been investing in real estate and energy supply and data centers for decades, long before people called it AI infrastructure. And while it is exciting because it is one of the largest and fastest growing themes around the world, it's important to recognize that the approach we take in investing and building AI infrastructure is no different to every other type of infrastructure we invest in. Investing in a physical toll road or pipeline or a processing facility is no different than investing in a digital toll road or pipeline or processing facility. And therefore, we're using the same discipline, investing in the best assets, in the best markets, with the best contracts and the best corporate credit counterparties. The only thing that is different today is the supply-demand imbalance for AI infrastructure is so incredibly in favor due to the need from the largest sovereigns and the best corporates around the world for AI and compute capacity.
Well, they want to spend, the hyperscalers alone, $750 billion. Connor, is that something, you know this world well, is that something they can even achieve just given the bottlenecks that you're laying out?
They can achieve it, but the point you are highlighting is perhaps the right one, in that the bottleneck here is not demand and it's not capital. The bottleneck is credible operators who can pull these very large projects out of the ground on time and on budget. And this is where we are really seeing the market increasingly favorable to not just those that have capital, but those that have capital and operating capabilities at scale. And these projects are so significant that they're often done in partnerships between very large businesses across different components of the value chain. We're seeing this around the world. We just partnered in South Korea with Novo and Nvidia. We just partnered in Kentucky and Paducah with NextEra and the Department of Energy. We feel very fortunate that we're extremely well placed at the epicenter of some of these very large projects that have very attractive investment returns.
On that NextEra one, just using that as an example, a really large deal, $100 billion, you mentioned both with them and with the government. Connor, is it no coincidence that that took place on federal land? How much are you thinking about some of these localities pushing back, whether it be New York City putting a memorandum, New York as a state rather, memorandum on data centers? Is that front of mind for you? Could that become a larger issue?
The demand that we are seeing is overwhelming. It is not going to come from every location and every counterparty and every asset class around the world, but there is certainly more demand than there is supply. So are certain regions, I'm not here to question their motives, are certain regions going to self-select out of this build? They may choose to do that. Does that mean that the supply demand is not in favorable of those that can produce and pull these projects out of the ground? Absolutely not. There is still a supply demand imbalance that it is very difficult to see it not being favorable of builders and investors into these projects through the end of this decade and beyond.
In terms of finding credible operators, because it's a lot of money to be put to work, and I understand you're probably not steeped in the day-to-day, but when it comes to energy, there has been questions around golden peaks in Europe. They borrow $1.6 billion, including $280 million from Brookfield to build solar farms across Eastern Europe. Their cash reserves vanished down to something like $1 million. Connor, do you have any understanding of what exactly went wrong there?
This is, a normal course part of our business. This was part of our infrastructure lending strategy. We had great creditor protections in our loan. Unfortunately, the business plan didn't pay out for the previous owners of that business. So no different than we've done in other situations. We'll step in and bring our operating capabilities to bear to finish those projects and deliver the value that they originally intended. And this is just unlike what we're seeing when we buy new platforms around the world and we continue to invest in new projects. Our ability is not just the ability to bring capital, but by integrating those projects into our broader pipeline, we can drive operating improvement, we can drive efficiencies, we can accelerate growth and use that to enhance the value.
That was Brookfield Asset Management CEO Connor Teskey speaking with me following the firm's earnings report. You can listen to that whole interview on Bloomberg.com and your terminal. Mike, I think it's just interesting to emphasize the winners and losers from AI. Clearly, a lot of the private markets companies are doing really well because they're in the infrastructure trade. But in public markets, there's been a clear differentiation. And I do just want to revisit the Citadel story, which we've been discussing, to make sure that we get these numbers right and emphasize them. So their flagship fund surged 5.9% in July. That means that for Wellington, their flagship fund, the year-to-date gains at Citadel Mike are now 12%. Before that, they were only up 5.7% year-to-date through the kind of late middle of July. Just to compare, Millennium only up 8.2%. So that one really savvy trade to dip in, buy situational awareness, hugely boost Citadel through the end, at least what we have so far year to date.
Well, you have to give Ken Griffin credit because obviously they picked up a very valuable piece of, what do we want to call it, real estate or something like that in the AI sector, and it has made a big difference for them. But I also like the way you said Millennium's up only 8.7%.
You're right. I mean, look, this market is hard, and I have to say some other funds really got slammed in the AI trade. Hema Parmar was talking about Whale Rock that had a really miserable month because of the way AI sold off. And again, it's this thing that, yes, you can be diversified maybe within the AI trade. You've been speaking to that, which I think is really interesting. Not everything trades together, but when a fund sells off all of its position, everything gets slammed. It's how a fire sale works.
We also have the calendar issue. I mean, we see the AI stocks go up, then they go down, and then they go back up again, and you're really where you were, but because the month ended in the middle of it, it makes your returns look worse.
It's true. It's sometimes like a random date and time is arbitrary. So point well taken, Mike. Let's get an arbitrary check on where we are in markets. 10:39 a.m., about an hour into your trading day. And we are looking at the NASDAQ now falling. It's down 0.05%. So that, I mean, it's barely a fall. It's basically unchanged. But some of the gains of the S&P have started to lessen. We are now only up about 1/3 of 1% as SpaceX, AMD, they continue to sell off with some other earnings that did shine. Not a lot of movement, but 10-year yields now moving higher, up by about 1 basis point. Brent crude falls to just under $79 a barrel. The Treasury website posting something on the U.S. removing Iran-related sanctions, so that seems to be helping oil slide at least a little bit, but NASDAQ just barely treading water. Let's take a look at some of your other movers on our radar this morning. With that is Nora. Good morning, Nora.
Good morning. Let's kick things off with healthcare. I'm looking at shares of Eli Lilly. We're seeing shares higher after strong demand for its weight loss and diabetes drugs has the company raising its sales outlook for next year. We're seeing shares up about 4%. Now, remember when Novo Nordisk was leading this race, Eli Lilly has clearly pulled ahead. And sticking with healthcare, moving over to CVS, heading for its worst day since January. Stock seeing some pressure, down about 6%. We've got investors that are looking past another strong quarter from Aetna, and they're focused on weaker profit outlook for next year. The company also says that Caremark Pharmacy, its mail-in business, is expected to lose members. And finally, one more name in the red, Uber, lower by 5.8%. This comes after a forecast that came in line with expectations, but investors were looking for more. The company also says that it's seeing tougher competition in Brazil, which is one of its key markets, while Wall Street is really trying to figure out what the rise of robo-taxis means for Uber's long-term growth. Not sure how I feel about robo-taxis, but I guess that's what investors are looking for. Don't miss our interview with the CEO of Uber on Bloomberg Tech at 11 a.m. New York time. Those are your morning movers. Dani?
Nora, thank you very much. Coming up on this show, Carlyle notches its best earnings in 4 years. Thanks to PE exits, we're going to speak with the company's CFO, That's coming up next. This is Bloomberg Open Interest. Carlyle posting its highest quarterly earnings in almost 4 years, boosted by private equity bets and private equity exits. Assets under management rose more than 4% from a year ago to $485 billion. And now Carlyle has ended this quarter with a record $97 billion available to invest. Joining us now with a Bloomberg exclusive is Justin Plouffe, Carlyle's Chief Financial Officer. Justin, thank you so much for joining us.
Dani,
great to see you.
Thanks for having me.
Look, a stellar quarter for exits, a lot of realizations. The conversation for this industry, especially private equity, had been it's gummed up. There's a dam that needs to break. Has the dam broke, or is this just Carlyle doing a good job of selling things?
Well, look, we've been exiting at a very good rate for more than a year now. And our exits have been really broad-based. We had great exits in the quarter from Japan, from Europe Technology, from U.S. real estate. And our U.S. buyout team, they've distributed 23% of fair market value over the last 12 months. That's twice the industry average. So for us, it's more of the same. Capital markets are open. It's a good environment, and we're finding great opportunities to exit and to invest.
Can I ask how those exits are happening? Because, again, part of the narrative had been there's a disconnect between buyers and sellers. Does that mean when you exit, you're having to take down valuations, or is it just the best stuff that you're selling so you can sell it at a better valuation?
Well, it's certainly not that. I think we're finding buyers both in the M&A market. We've also had very successful IPOs in the past year. So we're really taking all opportunities to realize investments when we think it's the right time for to maximize value for the investors. And again, it's been global. We've had these exits all over the world across many different industry sectors. So it's not just one place that is open for exits. Really, the market is open if you have good companies and you know how to find the right buyer.
Speaking of the right timing, we've got this little war going on, and now you have introduced a defense platform.
Yeah, we've been investing in aerospace and defense for our entire history, almost 40 years. We now do have a specific platform aimed at defense and reindustrialization. And this quarter, we actually did our first deal out of that platform, a company called Secturion Systems, which provides encryption to governments and to government contractors so they can send classified information securely. But this is a long-term focus for us. The focus on national security, on data infrastructure, we see an enormous amount of opportunity here. And so we think there'll be a lot of demand for that type of strategy.
Justin, thinking about that platform, some of the big exits you had, Medline, a healthcare company.
Yep.
These aren't exactly like high-flying AI names. Is that a coincidence, or is that a specific choice that you're making not to really chase after the AI trade everyone else is?
Yeah, when we invest at Carlyle, the core tenet is diversification. We've always been diversified across many different industries. You know, our power alleys are aerospace and defense, healthcare, financial services, and we found great opportunities to invest in these spaces. But I think it's important to understand AI as a technology, it's not just about pure play AI. AI is going to revolutionize every industry. And if you look historically at technological revolutions, some of the best investments are actually when a company takes the new technology, figures out how to apply it to their specific industry, their specific company, and then jumps to become a market leader because of that. So we're implementing AI. AI is a big theme. We're just not focused on only pure play AI. We're focused on many different industries.
Do you think there is a risk, though, that this industry, and I guess maybe say for Carlyle if you're not doing it, is getting overly concentrated in AI?
Well, there's certainly a lot of capital demand for AI. And clearly the hyperscalers have put massive amounts of capital there. They're now coming to the private markets to get more capital. But for us as a private markets investment firm, that's an opportunity. They need our capital. We can be very selective where we put our capital. So is there a risk? There's always a risk, but AI also is going to be transformative, and we're very front-footed about employing it.
You've talked about credit and alternative strategies being strong for you in the quarter, and there have been questions about the private credit market, certainly. How are you navigating that?
Yeah, so I invested in credit for almost 20 years of my career before I became CFO. And I can tell you, in our portfolio, our companies are strong. We're not seeing increases in default rates that you might expect. We're seeing management teams really able to navigate this environment. And it is a tricky environment, especially from a geopolitical standpoint. But our portfolios look very, very good. And ultimately, I think this narrative around private credit, the one thing that will solve it is performance. If our funds and the industry continue to perform well, as it has in the past, then I think investors will come back and see that it has a place in a well-diversified portfolio.
We are, though, starting to see more broadly public markets, too, spreads start to widen. To be fair, a lot of that is concentrated in tech. But it does seem like a market is somewhat concerned about some of the borrowing levels, especially if the Fed doesn't seem like they're going to cut and might even hike rates. Is there something to that, some of the jitters that appear to be happening, at least in public markets at this point?
So I'd say it's bifurcated. If you look at our markets outside of software, spreads are actually relatively tight still. They're coming off of all-time tights, but I would characterize those capital markets as very open to do business, and new deals can get done very well. Software is a little bit different. It's more difficult to get deals done in the software space. But remember, a few years ago, when rates went up for the first time in basically a decade, people said, wow, there have been so many defaults. These companies won't be able to make their interest payments. And what did we see? Well, management teams were able to handle that. They adjusted their business plans. We didn't see the wave of defaults that was predicted. So this market is very much able to handle different types of situations. We manage through all sorts of environments economically. I think the market will remain relatively strong, even if that happens.
We have a new Fed chair who wants to increase surveillance of a lot of different parts of the economy. And you're a private company, and you say you're doing very well, but how much are you willing to work with them on giving information that would give them a better view into this sort of thing?
We're very transparent. We've always been transparent, regardless of administration. I've been to Washington, D.C. many times to talk to regulators. Our firm was started in Washington, D.C. We have great connectivity there. There's nothing that private markets need to hide. We're very transparent about what we do and what we bring to the economy. Private markets are now so large that they are a massive force in not just the U.S. economy, but the global economy. And we're happy to work with the administration on showing them what really we do every day.
And for the private capital funds, the larger are just getting larger. There's been a lot of M&A. And I have to say, maybe kind of the knock people would say on Carlyle, the reason maybe you're not participating in AI as much is because you're not one of these like behemoth platforms that have this insane amount of capital to invest. I wonder if you would want to grow and if you would want to do it inorganically specifically, because I'm assuming it is nice to grow regardless or not. But would you ever look at inorganic growth? Would you ever look at M&A to get bigger in general?
We always look at opportunities, but inorganic growth is difficult. A lot of things have to work, right? The businesses have to work together, the people have to work together. And right now, we put out a plan in February that was 100% organic. We feel great about that plan. I think our shareholders feel great about that plan. So we don't need inorganic growth to achieve our goals. If something comes along that really is a good fit, of course we'll look at that.
Would it be helpful, though, to be bigger to start competing with some more of the infrastructure deals that are going on?
Well, we're pretty big already.
No, you are. No, you definitely are.
Size is
no, wait, to be
limiting
very
us.
clear, you are one of the big players, but you're not like an Apollo with an Athene in your back pocket.
Yeah.
You know?
Yeah. Well, look, Apollo has a very different business model, right? They merged with an insurance company. They have a large balance sheet. We have intentionally been balance sheet light, and for our entire history, we've been a firm focused on investments and investment returns, and we're going to stay that way.
And a fantastic quarter. Thank you so much, Justin, for joining us.
Thanks
we appreciate your time.
Thank you.
Justin Plouffe of Carlyle. You're watching Open Interest. A check on your markets as we head to the end of the hour. We are still rallying, but tech now struggling to catch a bid, down 0.1%, and the S&P's overall gains are also starting to peter out, only up 0.2%. Philadelphia Semiconductor Index, that's now dragging down things at 1.33% drop as some, again, those high-flying semiconductors, which had rebounded, start to reverse. Brent crude at $78 a barrel, 93 cents. Catch me at Bloomberg Deals today, 12 p.m. New York time. Starboard Value CEO Jeff Smith will be joining me for an exclusive interview. Tomorrow on Open Interest, Mike is back and we'll speak to Krispy Kreme and Lincoln International.